Good morning, ladies and gentlemen, and welcome to the BlackRock Energy and Resources Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Tom Hull. Tom, good morning, sir.
Good morning. Thank you very much, everybody, for joining or joining a replay of this event. So, just a quick introduction to myself. My name is Tom Hull, one of the two co-managers on the BlackRock Energy and Resources Income Trust, alongside my colleague Mark Hume. I've been with BlackRock just under 20 years now, with my focus for that time mostly on the mining sector and the broader natural resources space. And Mark has been with BlackRock just under 10 years, with almost 25 years of industry experience, and his background is very much on the energy side of the business. So between the two of us, we have all of the areas that the fund invests in covered. One thing that's really important to note is, although it is the two of us that are ultimately accountable for the decision making within the portfolio, we sit within an incredibly well-resourced team here within the equities division of BlackRock. We have a great array of other portfolio managers across materials, energy, and agriculture, as well as analysts who sit within those three segments as well. Everyone has a very varied background. So we have people like Mark, who's a petroleum engineer. We have mining engineers such as Aidan, who works with me on the materials pod. And then we have expertise, across that breadth of the entire energy sector. I think it's really important when we think about energy, we don't think about conventional energy and so-called renewable or clean energy as distinct. We think about one energy ecosystem and the way that all of these different sources of energy and demand for energy interact with each other. So having this holistic platform to us is incredibly important. I think it's really sort of helpful to set the scene here as to what the trust is aiming to do. So if you look back 5 years ago, we made the decision to transition this trust away from just focusing on the mining sectors and the traditional or conventional energy sectors, essentially hydrocarbons, to instead incorporate a substantial amount of the portfolio into the energy transition. And then really there were a couple of reasons for this. The first was to re-inject an element of structural growth back into the portfolio. When this trust was launched, almost 20 years ago now, mining and conventional energy were two of the growthier parts of the market. If you think back to the 2000s, a large part of market narrative was around the commodity super cycle, the China super cycle, and that drove many years of structural growth for the mining and traditional energy sectors. However, as rates of economic growth have cooled in China, and as the commodity intensity of that growth has reduced back in the 2000s, for every 1% of GDP growth in China, you'd see 2% or more growth in demand for commodities. Now, for every 1% of economic growth in China, you're often seeing less than 1% growth in commodity demand. So a real shift both in the level of demand or economic growth in China and the commodity intensity of that. And so now, for much of the last 10 years, we've seen these traditional energy and mining sectors thought of more as value sectors. And we really wanted to sort of reinvigorate the trust and inject that element of growth back into it. And if we look at what's happening in the energy transition space, it is not just about a change in the supply side, and we'll explore this a bit later. Yes, there is that greening of energy, trying to reduce the carbon intensity of energy generation and transmission. But there is also the recognition that energy demand is really changing as well, and the sources of those demand. And we've seen that, first of all, really with the mainstream adoption of electric vehicles, but over the last couple of years, the emergence of AI and data centers, is a key driver of electricity demand, and how countries around the world and energy systems around the world react to meet that rising demand, and which has really re-injected some interesting elements of structural growth back into a number of parts of the energy chain. Something that we find quite exciting. And so when we look at the portfolio today, we see a portfolio that is quite different to how it was for much of the last 15 years before it. And that energy transition piece to us is really important. We'll go into a little bit more detail later about how we're positioned today and some of the changes we've made over the last 6 to 12 months, as we've really seen the opportunity set shift between these three buckets. If we go and now look at these two charts here, and I think the chart on the right-hand side is perhaps a bit clearer to see. And this is a chart of those three main sector breakdowns, since we made the transition back in the middle of 2020. And what you can see is that when we made that transition initially, for much of the last, sort of 4 or 5 years, we've been underweight the energy transition relative to that 30% neutral position. So we've been running at only sort of low 20s% in terms of the portfolio's exposure to the energy transition. Now, as we went through 2023 and 2024, we began to reduce that underweight. We then increased it again when the first signs of the Trump administration's policy framework came in. But very recently, we've actually gone overweight the energy transition. And this is really because for two reasons. One, which is a positive thing, is that we've seen the valuations that energy transitions companies trade at go to a discount to overall market valuations for the first time in many, many years. So if you think back to that sort of post-COVID period where we were underweight, those green bars being firmly beneath that x-axis on the right-hand side there was arguably quite a lot of hype embedded in some of the energy transition stocks. People were extrapolating high growth rates well into the future and probably using costs of capital that were, artificially low. Fast forward to today, and it's completely different. Growth rates are still high for many of these companies, but the sentiment towards them, with the Trump administration coming in, really spooked markets and really changed market sentiment towards these areas from one of optimism to one of actually quite deep-rooted pessimism. And we think it's thrown up now a number of really interesting opportunities from a valuation perspective. So we've changed that positioning. At the same time, our outlook for conventional energy has also softened. So again, if we think back, to that post-COVID period, we had, people calling for low oil prices for a very long time. If you remember, at one point even, oil prices went negative, and energy equities were trading at very, very low multiples. And we thought that was just too pessimistic when we think about the world's insatiable demand for energy of all types, and that very strong correlation between GDP per capita and energy consumed per capita. We thought the market was just too pessimistic. And that's why we ran an conventional energy overweight for much of the last 5 years. However, today, oil markets are pretty well supplied, and we'll show some charts later that show that. And so actually, on a relative basis, we find the opportunities in these equities to be slightly less compelling today, especially relative to those energy transition opportunities, than they were for much of the last 5 years, and hence we've made that quite big shift in the portfolio. But it's not just about how we allocate between those three main buckets. It's also about how we move between the different areas within there. And you can see really over the last 6 or 7 months some of the shifts that have occurred under the hood here. And you can see some of the biggest changes have been within that traditional or conventional energy space, where we've reduced our exploration and production exposure. This is the more oil price sensitive part of the portfolio. So really taken that down and almost halving of that position. And we've allocated some of that capital to the integrated energy companies, where we find the free cash flow yield still pretty attractive. But really, quite a bit of that capital has been allocated to that energy transition piece. And you can see there, an increase in our exposure to energy storage, but also a step up in our exposure to the electrification bucket and the renewable generation piece, where we found some quite exciting opportunities as well. I do want to touch on income generation because whilst I talk about the energy transition being incorporated to try and re-inject some structural growth back into the portfolio, it's also important to remember that there is the income focus of this trust as well, and it's something that we know many of our shareholders have a long-standing relationship with the trust because of this income element. And what you can see on the left-hand side there is that over the last 3 years, our sources of income have moved back to what I would consider a better balance than perhaps what we had, back 5-6 years ago, when we were generating almost 40% of our income from option premium. That's now halved back to sort of circa 20%, with the underlying dividends from the portfolio and some of our fixed interest securities generating the vast majority of our income. Frustratingly, on the right-hand side, you can see there that over the last couple of years, the trust has traded at a pretty consistent discount to NAV of around about 10%, which, given our growth ambitions, is a touch frustrating, especially when you think of the quality of the underlying portfolio, the liquidity of the underlying portfolio. But I would note that during this period, if you look at the announcements that are put out on a regular basis by the company, the board has been fairly active in buying back the shares. So we are aware, of trying to manage this discount that the trust has been trading at. But I would also note this is an affliction that has hurt, the broader investment trust sector, and so it's not unique or specific to Berry. Maybe now, if we dive in to the sectors themselves, and really we think of the energy transition in sort of three main areas: clean power, including utilities that are generating clean energy, the renewable energy technology, and then really importantly, the grid infrastructure and energy storage. This is a piece which, for many, many years, grids and networks have been thought of as low to no growth areas. Now, with rising electricity demand across major economies, driven by the electrification of transport, the reshoring of manufacturing in the US, and the emergence of the importance of data centers and AI, these grids have gone from being no or low growth to actually having an element of growth to them. This is really exciting and an area we think we can find some differentiated investments. If we look there at the middle pillar, energy efficiency, obviously growing the supply of energy is very important given the factors that we're seeing in the energy market, but doing more with the same, extracting more juice from the lemon is also really important. Reducing wastage, doing more with less is something that is not only good for environmental outcomes, but critically is driven by economic forces. And I think that's something that I'd like to stress across these three pillars, is actually we are entering an era now with the energy transition where it is going to be driven by security of supply and economics, and supported by regulation, not driven by or dependent on regulation. And I think that's really important to think about the sustainability or durability of some of the trends we can see. We then got the final pillar, which is clean transportation. I think here, the most notable thing that people point to are electric vehicles. Obviously you see that in the world around you, being driven very much by China, but also, you are starting to see Western countries catch up in their growth rates of EV adoption. Arguably, Western countries have lagged in terms of infrastructure investment, so you've not quite seen the pace of adoption be what some would have hoped 3 or 4 years ago. But as you see, the rapid improvement in vehicle technology and the infrastructure begin to catch up, this is a trend that we think will continue, over the next 5 to 10 years, and offer up some really interesting investment opportunities, throughout the supply chain for these. I do want to touch on energy security because I think this is something, that is often overlooked, and it's where all forms of energy are going to need to play a role as countries look to foster greater self-sufficiency. And you can see this whether you're looking at China with its significant growth in clean energy generation, also coming alongside investment in other forms of generation. And so we very much think you're going to see an all of the above approach, a need to reinvest in traditional energy, hopefully whilst also making it cleaner. So switching out coal to gas, for example, which has been, one of the key drivers of improving emissions intensity in the United States grid, for example, over the last 10 plus years. But also investing in clean power to meet, that rising demand for power, across global economies. I touched on it in some earlier comments, but I think it's really important to think about, the re-emergence of growth of electricity demand in Western economies, and we've got some examples here. And the right-hand side focuses on the US, where post the financial crisis, really for much of the last 15 years, you've seen anemic growth in electricity demand. And that's as we've seen manufacturing hollowed out and offshored. You've seen a declining commodity intensity of GDP growth, really as the service sector has dominated economic growth over the last 10 to 15 years. Now you're starting to see a very different shape to that economic growth. You've seen a step change in the capital expenditure plans of the technology companies as they look to really, have a generational investment in data centers and AI querying, and you can see that in terms of the energy demand forecast from such activities on the left-hand side there, and that's really transforming that energy demand, that electricity demand in the US. And this is not using optimistic figures for the adoption of electric vehicles. And actually, if you do see a faster than expected adoption of electric vehicles, that will only add to these growth rates that you see here. And I think, that chart on the right-hand side really does show the importance of it's an everything above solution to energy markets. So whilst the majority of the growth in electricity consumption is going to be met through the addition of renewables, principally solar, but also to a lesser extent wind, we are still going to need that base load of gas-fired power there, and that's why we see plenty of investment opportunities still on that conventional energy side and in industries associated with electricity generation from conventional sources. Important here just to stress, the continued technology improvements that we're seeing when it comes to renewable generation. And you can see here charts on the left-hand side which show the improvement in efficiency of photovoltaic or solar modules, and the collapse really in the dollars per watt of solar energy, which is really important and really exciting. Now, one thing I think that has been overlooked whilst people are focused on this exciting trend has been the stability of grids and the investment in grids to allow these intermittent sources of production to be a larger feature of grids. I think that's something that has really been highlighted by some of the recent blackouts. But for us, rather than see that as something that should be used as political mudslinging to push back against the rollout of renewables, we see that as, well, what is going to be the missing piece of the jigsaw to allow these forms of generation to thrive within networks and grids. And it's going to be that investment in storage, smart grids, backup power. And that's where we can then go and look for some esoteric investment opportunities for the trust. If we then turn to conventional energy, and here we've become slightly less excited than we were 12 or 24 months ago. And that's really because in the second half of this year, we expect oil markets to remain in balance, if not slightly oversupplied. And really, when you look at some of the events that we've seen geopolitically over the last couple of months, you might have expected those to send the oil price back up to sort of that $100 a barrel range that we've seen in the past. But the fact that we didn't see that, I think, shows two things. One, that markets aren't too concerned if a modest amount of supply came out of the market for a short period of time, because there's ample spare capacity and inventory to manage through a temporary disruption. And two, you didn't see the events in the Middle East regarding major oil producers spiral and threaten oil production outside of more than one country. And that lack of contagion is something that is different today versus, I think, other periods in history where we've seen potential geopolitical strife. And so, for that reason, we think there's less right tail or significant upside price risk from geopolitical shocks for the balance of 2025. And so we've become, just less positive on the outlook for conventional energy. However, when we look out into 2026 and 2027, what's really important to look at there is the fact that the US is now a really important producer of oil. And unlike some large offshore assets, where once you've made that investment, that supply pumps, albeit with a decline rate for many, many years, in the US, you have very much short life assets in the shale industry, high decline rates, a need for lots of reinvestment to maintain, let alone grow production. As we started to see a falling rig count and a lower reinvestment rate at these lower oil prices, at some point, that will cause that supply in the US to plateau and then eventually begin to come down on the other side of the curve, and that will begin to tighten oil markets again. So we look out into 2026, 2027, and we do see a slightly brighter picture. And we do think on the demand side that people's talks of peak oil and then a sharp contraction in demand are overdone. And actually, we think that oil demand will remain higher for longer. And so we do think once we're past this point of sort of oversupply, there are going to be some interesting investment opportunities once again re-emerge. And I think these charts here really point to that. And you can see on the left-hand side there, a lot of people a few years ago were focused on that green line, that net zero trajectory. And I think you've seen a lot more, the emergence of energy pragmatism in the market. And now we see, a far slower, smoother glide down in oil demand and oil output over the next 20 to 25 years. And that chart on the right-hand side there points to what I was talking about in terms of, that slowing of production growth from the US. You look out beyond that 2027, and at current oil prices, you'll probably see that plateau, and if anything, roll off down the other side. One of the reasons we haven't taken the conventional energy sector down more than we have done really is the relative value that we see in the energy equities today. You still have the European integrators, for example, trading on very attractive free cash flow yields. So when we view that relative to some of the other opportunities in the market, say we compare the valuation to the diversified mining companies, we find their valuation still very supportive. And so we haven't taken them down further than we already have done. We touched then on the mining side, and really, mining is a tale of a number of positives, really offset by one major negative. And actually, on the positive side, you've seen companies remain very disciplined in the mining sector. You really have seen, a lack of exuberant investment in new supply. People are very cautious in their price forecasts that they are putting in to models when thinking about allocating future capital. You've seen balance sheets remain very strong. You've not seen reckless M&A, and a lot of mine commodity prices are still at quite robust levels. However, the reason you've not seen this supply discipline translate into brighter prices on the mining side is really the subpar performance from China's economy, in particular. Some of the steel-intensive areas of China's economy, on real estate and what I define as sort of conventional infrastructure. Also, post-COVID, you've had some pretty strong cost inflation in 2022 and 2023 in the operating costs and capital cost side for mining companies. So margins have struggled to really expand. If we look at what's going to drive mined commodity demand going forward, and whilst you can't escape what China's economy and its impact on mined commodities, you are seeing a change in the shape of the demand growth for mined commodities, and nowhere is this more evident than in copper on the right-hand side there, where you can really see over the next 10 years, we expect demand to be driven, demand growth to be driven by the investment in clean energy technologies, as well as electricity grids and AI and data center demand. This is very different to the mental model that most people have of what drives copper demand growth, typically being Chinese real estate, which is really falling in its importance in terms of share of copper demand. I think it's also really important to remember just how materials intensive the energy transition is going to be. If we look at the materials intensity of solar and wind compared to, say, gas generation, solar and wind are orders of magnitude more commodity intensive, in particular in aluminium and copper. And that's, I think, quite exciting. And it is also front-end loaded. If you think about traditional energy generation, you obviously have to spend your capital to build your electricity plant. And then you have to commit energy and resources to extracting the fuel stuffs to feed that gas turbine or that coal turbine for the next 20 to 30 years. However, with transition and clean technologies, because you are utilizing wind or solar as your input, all of those commodities that you utilize are employed in the establishment of that generation. So the manufacture of the solar panels and then the mounting of them and the installation of the concrete they need to go on, steel that those panels need to sit on, and for the wind turbines, the enormous amounts of steel and cement that are required in the foundations, plus then the materials that are used in the blades for the turbines themselves. And so that's really exciting because you need to have this massive initial investment in that generation capacity, which is very materials intensive. And it's something that I still think is being underestimated today. You read some of the academic papers on the theoretical adoption of renewables within grids globally, and I've always been quite surprised at the lack of constraining factor being materials availability. It's often not even considered, even though in some of them you end up consuming 50 to 70% of the world's supply annually of one of these commodities. And I find that to be quite interesting, quite exciting when we think about the outlook for demand supply balances for mined materials. And you're not seeing companies respond to this positive outlook. You can see there, on the left-hand side, this is a sector that is retrenched in terms of its capital expenditure. We have seen a little bit of an increase in expansionary capex as a share of overall capex in the last few years, but nothing like the levels that we saw in the China super cycle or in that post-GFC boom. And you can see there in the chart on the right-hand side, you've seen an improvement from those sort of 2016, 2017 lows in terms of capex as a proportion of depreciation, but it's gone nowhere near the sort of 3 times multiple that we saw during that period of overinvestment post the global financial crisis. And I think this really sets the sector up from a company perspective to be quite resilient going forwards. And this is a sector where I don't think that resilience of balance sheet, resilience of assets is really being factored into valuations. And you can see that whether you look at valuations relative to MSCI on the left-hand side there, or relative to the sector's own history in terms of EV/EBITDA on the right-hand side there. I will close off there. I will move back to the summary sheet so that we can then take questions from the audience. So why don't we open it up for any questions, and then let's go from there.
Tom, that's great, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Tom, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But Tom, perhaps if we dive straight into it, the first question that we have here reads as follows. What is the impact on this trust if inflation expectations start to rise?
Yeah, so I think it's a really interesting question, because I think the last time we saw inflation expectations start to rise was really because commodity prices were one of the key drivers of those inflation expectations rising. When we think back to the performance of oil prices during that time, as well as other commodities. So I think if for whatever reason we an exogenous shock to supply chains, etc., begins to cause inflation again, that is going to throw up investment opportunities that I think are going to be more centered in our universe than they are perhaps in the market as a whole. And so whilst obviously it provides a headwind for operating costs for some of our companies, through hopefully astute stock selection, we will be able to find those that are going to benefit more than they will suffer from any pickup in the inflationary environment. I think that's something which is perhaps not as prevalent in other parts of the market as it is in this sort of energy and resources space.
Thanks, Tom. And just turning to the next question that we have here, what does the electric vehicle revolution mean for oil demand?
Yeah, so I think it's really interesting if you look at the demand for sort of all types of energy, and I think everyone's been slightly surprised that despite the fact you've seen significant adoption of EVs globally, albeit at a slightly lower pace than some would have thought 3 or 4 years ago, oil demand continues to make record highs. And I think that's because you do have many other sources of oil demand than just light vehicle transport. Now, if as we go through the next 10 to 20 years, will battery technology and other technologies, also mean a transition away from, diesel and petroleum for heavy trucking, maybe even some forms of marine and air transport, perhaps. But those are going to be far harder to move away from liquid hydrocarbon fuels than some forms of light vehicles that we've seen transition to date. And so I think the pace of decline of oil demand that some have forecast is perhaps just a touch pessimistic. And when you look at the valuations that oil producers trade on, I'd argue that they are pricing in two things. One, a more rapid decline in the market for the end markets for their products, and two, an assumption that they misuse the cash flows that are being generated today. And I think actually management teams across the extractives industry, are becoming a lot more astute and a lot less of that sort of boom bust mindset that we perhaps saw in the commodity super cycle and then in the subsequent sort of 2010 through 16 period, where I think many of the mistakes of that commodity super cycle, were indeed repeated, in that period, which is probably why that muscle memory of investors, does think quite poorly of the capital allocation of these groups of companies because of several poor experiences during their investment lifetimes.
Thanks, Tom. The next question that we have here is on China, and I know you touched on this during the presentation, but perhaps if there's anything further to add. The question asks, do we need to see a stronger China for the miners to perform well? And can China turn around its struggling economy?
Yeah. So I think to see miners outperform oil companies and the other areas that we can invest in our trust, I think you need to see a China which stops getting worse. I don't think you need to see the sort of stimulus bazooka be deployed like it was, say, at the end of 2015, beginning of 2016, where you really saw an enormous injection of stimulus into what you'd probably think of as the old economy in China, around real estate, etc. You just need to, I think, see some of the areas stop getting worse, and we're starting to see that on the real estate side, albeit from a very low base. But I think you've also then got to look at other areas of China where you are seeing substantial growth. If you look at the grid investments in China and investments in renewable energy generation, they have been nothing short of spectacular. If you look at the latest data, China installed the same amount of solar in a month that some countries would have, as their entire installed base, just under 100 gigawatts. Remarkable pace of deployment of solar energy. And so actually, when you look at the copper demand from China, it's not nearly as bad as you would fear if you just looked at that through the lens of real estate. And so I think you have to also think about that changing nature of China's economy. Now, obviously, there are going to be losers within this. So you look at the bulk commodities, iron ore and metallurgical coal, for example. The outlooks for those industry, for the prices of those commodities, is probably quite a lot less exciting today than at other points in the last 10 to 15 years. However, when you look at, for example, the shape of the cost curve in iron ore, it's still pretty steep. The world's best iron ore producers, are still generating gross margins, 60 to 70%. That's a pretty fabulous business. If you think we're at a cyclical low for the end uses of that iron ore, which goes into steel making in China. Yes, I think if you are a China bear, if you think that China is in a vicious debt spiral, and you think you're going to see continued sort of negative growth in real estate, etc., and that will have contagion into other areas of Chinese economy, then yes, it would be hard to be positive on mining. I don't think we're that pessimistic. I think I think we're a lot more sort of in the middle of the road as to where China's economy goes from our team's perspective. And that means I think that you can then start to focus on some of the more esoteric opportunities in mining that are being driven by the emergence of some exciting new technologies, the broader adoption of renewable energy globally, and the commodity re-intensification of GDP growth. In non-Chinese economies. So you look at the US and Europe, for example, reshoring of manufacturing. Growth in energy, electricity generation. This is, once again, increasing the commodity intensity of GDP growth, which is a very different situation than we found for most of the last 20 years in these economies.
Perfect, thank you. Do you think we could see more strength in gold and silver prices?
So precious metals have been, a real bright spot in mining over the last couple of years, and that's really as you've seen, a complete shift in who the marginal buyer of gold has been in the market. For much of the last sort of 15 to 20 years, the direction of the gold price has been determined as by whether Western investors are buying or selling gold, largely based on their views on US 10-year real interest rates. Because typically, as US real interest rates rise, there's an opportunity cost to holding gold, and so demand for it falls, or even investors become suppliers of gold into the market. And conversely, if real interest rates go less positive and even go into negative territory, then that opportunity cost of holding gold doesn't diminishes, and demand increases. Today, you've got a very different scenario where you've really, since the Russian invasion of Ukraine, seen the emergence of central banks as the key driver alongside Chinese consumers of gold demand, and that's caused a complete change in the correlation of gold with other macro economic indicators. So that correlation between US real rates and the gold price, which was also very high for much of the last 15 years, that over the last 2 to 3 years has basically gone to zero. So that's pretty exciting from a gold market perspective, and I think it's something that is not going to change overnight in the other direction when we think about the more fragmented world we are in now geopolitically, as well as I think the challenging fiscal situation that many governments around the world now find themselves in, and therefore the concerns people have about the value of paper or so-called fiat currency, and other alternative currencies, gold being one of them, has been a beneficiary, and I think will continue to be a beneficiary of that in the future.
Thanks, Tom. And perhaps one final question just to wrap up with. How does the current high level of geopolitical risk impact this investment trust?
Yeah, so I think if you had painted a picture of some of the events that have gone on in the last 12 to 18 months geopolitically, I think if you had painted that picture 12 or 18 months ago, people would have been a lot more excited about the outlook for oil prices than the reality that has played out. And as I touched upon in the presentation, I think that's a function of the lack of contagion, thankfully, from in terms of conflict from what we've seen, but also a oil market which is pretty well supplied, at least in the short run. So I don't think the geopolitical impacts on this portfolio are as large as the perception of them might be.
Perfect. Thanks, Tom. And if there are any further questions that do come in, we'll make these available to you immediately after the presentation has ended. But Tom, perhaps before really now, just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments just to wrap up with, that would be great.
Great. Well, first of all, thank you everyone who's stayed with the presentation and the Q&A till the end. Really do appreciate your time and interest in our product, in our trust, and the team running it. I think we're at a pretty exciting point, especially for the energy sector. When I say energy sector, I mean the energy ecosystem. We are at the point of some pretty exciting technological breakthroughs in terms of the cost competitiveness of renewable power, and at the same time, the optimism in the investment community about the role of renewable generation is probably as low as it ever has been. And so you've got valuation opportunities here that haven't existed for many, many years, despite the structural growth outlook actually being pretty exciting. And you've got more legs to this growth than I think we had 3, let alone 5 years ago, with the onshoring of manufacturing, the growing demand for electricity in Western economies, and the need to reinvest in grids, not only because of that growth, but also for replace aging infrastructure. And so the variety of investment opportunities we see today when it comes to that energy ecosystem, I think are a lot broader than many people would have at first glance or at first thought. And so I think for an active investor in this space, it's a really exciting time. And I still do think, as we look out longer term, that materials intensity of some of these structural changes that we're seeing is quite underappreciated. We can see it in some of the recent announcements around rare earths, for example, in the US, just how critical some of these materials are, and how necessary policy reaction sometimes is. And I think that means there are some, I think, quite exciting investment opportunities for those in the material space that are looking to take or are willing to take a slightly longer term and more strategic time horizon. But once again, thank you for staying the course here in this presentation and Q&A. And please do reach out with any other questions that you have. We'd be delighted for us and the team to get back to you.
Perfect, Tom. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the BlackRock Energy and Resources Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.